Hey everyone, it's James at Eurevo, New York's #1 commission rebate brokerage with our May Manhattan market update. And basically all the trends that we were looking at last month have continued and probably will continue going forward. We saw a decline in contract activity in May. We were down about 16% versus last year, and that's still compared to record levels, but you'll see in this chart here, we're basically tracking last year's demand for the first couple months of the year, and then over the last 2 months we've been down, and that decline has been growing. If we look at this by price point, it's actually interesting that the higher end, which had been the strongest part of the market all of last year, is now where we're seeing the largest declines. I mean, part of that is because we had such strong levels of demand last year that any fall off to a more normal level is going to look larger, but that's where we have seen more of the declines this year. And then on the inventory, we're down 9%, and that doesn't sound, it's still a decline, so it sounds good. But if you look at the chart here, you can see what we're comparing to. This is the salmon colored line here, that's 2022, and then this light blue is 2021. You can see at the beginning of the year, we were down like 20, 30%, so very large decreases. And basically we've been creeping up and getting pretty close to last year's levels. So we're seeing demand fall at the same time that inventory is increasing, and no surprise that is causing the market to slow down. And here again, you can see what's interesting is the largest increases have happened at the higher end of the market. So under 600,000, we're kind of flattish. 600,000 to a million, we're bleeding up a little bit, but this is the 1 to 2 million, and this is the 2 to 5 million. So basically, the supply has met the stronger demand at that price point. And then when we look at pricing, there's no reason to think that pricing is going to go up dramatically going forward, or at the very least, whatever it was going to do before interest rates went from 3 to 5%, it's going to be slower than that. And then what we have had happen over the last month, in addition to higher interest rates, is the stock market has taken a bit of a hit. So whether that's just people having less money in their brokerage accounts or just a confidence issue, that's impacting demand. And then this is just updating that 30-year fixed mortgage rate chart that we looked at last month. You can see we've basically been hovering around that 5% level. So not much of a change there, but still much higher than what we were seeing earlier in the year. So that's basically the setup, and there's no reason to think that any of these variables are going to change materially going forward, at least for the next couple months. So if we continue to have high interest rates, we continue to have a sagging to flattish stock market, and we continue to see more inventory hit the market, I don't really see why demand is going to be dramatically different. So we're basically looking for demand to continue to slip, inventory to continue to build. It's still a good market. It's still, I would say, a seller's market, but it's definitely been shifting back towards buyers. So if you're out there and you're looking for a deal, there are definitely more deals this time of now than there was earlier in the year. We'd be happy to help you out. We'd be happy to get you a commission rebate. So email us at info@eurevo.com, and we'll see you next month. Thanks a lot. Bye.